I can support and make advisors more efficient by providing the rules, but the accountability still lies within somebody, within a human, right? So it's not that AI can't do it. It's not an ability problem, it's an accountability problem. 87% of high net worth investors say relationship and trust is why they keep their advisor. It's not because they have the best strategies, right? It's the trust that they have in somebody else. All right. Thank you for tuning into the NAGOMI podcast today. I'm your host, Sean Obana, and today we're going to talk about why AI tools aren't sustainable in the long run. But before we get into that, I'm going to briefly talk about how the war in Iran is going to affect the markets. I think I've gotten some questions about what I think about what's going to happen, how it's going to affect the markets. And today is Monday, June 23rd, about 1 p.m. Pacific Standard Time. And this conflict in Iran is threatening the Strait of Hormuz. And well, why is that so important? Well, it's a key route for global oil exports. And well, why does oil matter so much? Well, it's a key to our energy, and energy is becoming an increasing concern for the amount of energy that we consume versus the amount we can sustainably produce. So we need oil dug out of the ground to produce the oil and the energy that we need to sustain the lifestyle that we need. I literally have a light on right there. I have a light on right there. I'm using some natural light, but I'm using energy to literally film this whole podcast. I'm using energy to pretty much do anything, and you're using energy to watch this right now, to listen to this right now on your device, right? And so when this does disrupt the oil supply chain supply from the Middle East, well, then oil prices will spike. What happens when anything spikes? Well, there's inflation, especially in oil, where energy is feeding into everything, right? Well, this rising inflation causes central banks to avoid cutting interest rates. And when interest rates stay high and there are higher prices, well, then the consumer stops spending, businesses stop spending, and with less spending there's less growth, right? And so when there's less and slower economic growth, when then companies earn less revenue, so it's this perpetual downfall. Nobody benefits, so the market ends up struggling and nobody knows what to do because everybody's losing money in that case. So that is something to think about there. But that's not the main topic of today. Today, we're going to talk about why widespread reliance on AI investment tools may not be the most sustainable thing, and how psychologically herd behavior and market efficiency can be a huge consequence to these AI investment tools, especially in diminishing alpha. And we'll get into what alpha means later. So what's the promise and the problem of AI investing tools? So AI investing tools are machine learning to make decisions, automate trades, and build portfolios using tools to analyze historical patterns and data sets, forecasting prices, and executing trades. Is really taking the human aspect of it. It's all automating it for you based on algorithms. So why is it becoming so popular? Well, there's Robinhood, there's ChatGPT finance prompts, there's robo-advisors, right? Well, there's a difference between efficiency and mimicry. What happens when everyone is using the same AI models? Well, there's trade convergence. For example, if everybody were to buy NVIDIA at once, well, then demand spikes and the prices increase irrationally, not based on fundamentals. While there is a huge other topic about, well, no stock is really fundamental based, right? It's all just about a perception. We can go into that later, but that's not the topic for today. We're just speaking more generally. And when, for example, GameStop, right? Everybody bought into that stock, creating a bubble when it's an irrational stock, irrationally valuated. And so The flip side to that is when that happens, the AI models will detect that the price for Nvidia in that case will be overvalued. So then everybody sells, there's price pressure, and it collapses. And mathematically, this creates a positive feedback loop, and the signal becomes identical for everybody using it. So there really is no benefit, no positive alpha for an investor using an AI tool. So there is a zero sum nature. If everyone acts the same, well, then no one gains an edge. Profits will depend on somebody making a mistake, but that won't happen if everybody's using the same AI tools, right? And so I mentioned this alpha decay. Alpha is excess return over the market. It's essentially beating the market. That's what every investor wants to do, beating the market, which is beating the S&P, right? But the alpha disappears when the same strategy becomes too popular, right? There's less gain over the market. People aren't making as much money as they would want to. And this is known as the crowded trade problem. This is a theory based from 2018. Franzini, Israel, and Moskowitz, trading cost of asset prices anomalies. That's a really cool source to check out. And some key concepts here. Well, there's efficient market hypothesis, and that explains that if all known information is already priced in and AI tools rely on the same data, there's no room for this alpha, says Eugene Fama, an American economist from 1970, and who wrote in Efficient Capital Markets, a review of theory and empirical work. AI models often use historical patterns, and there's this concept called data overfitting, and it becomes a systematic issue, especially when AI learns too much, right? So data fitting is when AI learns too much or looks too into the data, including some of the noise or the random patterns that they assume that will keep happening over time, right? So, for example, an AI model is trained on 10 years of stock data. It might learn that stocks go up after a rainy day in New York. But that just might be a coincidence. If it trades on that, it might perform well in the sample that it took, but not in real life, not in the future where we don't really know if anything is certain, right? So in sum, overfit models chase irrelevant indicators or too specific signals, and they fail to generalize the market condition when market conditions change. And that's from Goyle and Welch, a 2008 economists, in their a comprehensive look at empirical performance of equity premium prediction. And let's dive into behavioral economics. We talk a lot about how emotions affect financial decisions, and behavioral economics is the core of this podcast. So, well, what's imitation? What's herding? What's the illusion of control? We've talked about many times. Herd behavior is when investors mimic others' actions instead of acting individually. For example, right, into 2020 to 2021, the GameStop GME, right? Everybody saw that everybody else was going to buy because of Reddit, because of YouTube, and everybody knew that it was just because everybody else was buying it, beating out all the Wall Streeters, right? Another bias is overconfidence bias, right? Belief that using AI gives you an edge until everyone else uses it. And for example, an investor uses sentiment-driven AI and sees the surge in buy signals for tech stocks and ignores all of the overvaluation because the AI tool makes you feel validated. So that's a huge one, is seeking validation for your own thoughts, and that's partly out of our ego. And I think one of the biggest ones here is the illusion of control. AI feels precise. It feels like something almost above nature, and that AI is almost better than humans. That's why we fear it oftentimes. So we rely on it and say, AI did this for me. I'm going to rely solely on it. I can't really make any other decisions better than AI, so I'm just going to use AI and it's going to power all my decisions. But in the end of the day, AI and humans still interpret these results from these AI tools. For an example, an investor may override their advisor's advice because of sleek AI dashboard saying to rebalance into emerging markets, to buy gold, to buy commodities, right? To buy the Russell 1000, right? These are just all random examples. This isn't financial advice, but the AI tools seem smarter and seem like they're immune to flawed logic and timing, but that's just not true. They are totally flawed because of that. We trust it a little bit too much because we don't understand it and we actually fear it. So that makes us give in to something that we don't even know about. It's a little bit complicated there, but thinking you can succeed all on your own with just a tool, an AI tool, and just yourself, it gives you an illusion of control that I can do everything. I just need my chat bot and a little bit of AI to help drive my decisions when that's not fully true. I think that's why human investors, human wealth advisors are so important. We'll get that into that a little bit later. But let's dive into Kahneman's and Tversky's prospect theory. Decisions under uncertainty are not irrational, even are not rational. Sorry, decisions under uncertainty are not rational, even if tools appear rational. So even if AI tools tell you the most rational move or decision to make, we humans don't think rationally. So thanks to prospect theory, we fear losing more than we like winning. So that's why we freeze when stocks fall, and even why the smartest AI can't fully protect us from ourselves. So that's interesting, right? It's not about AI helping us to do something. It's AI is powerful enough to recommend us to do a lot of things, to say this is the context, this is a good decision to make now given all the things that you've told me based on all this data. But at the end of the day, the human still makes the decision after getting all of that data, that recommendation, and the AI tool can't help you from your own cognitive biases that play into your decisions. So, despite all of this information and efficiency, it's all up to you understanding yourself. That's why we started this podcast. And so, a little bit more of the fundamental and foundational aspects of why AI tools aren't sustainable is understanding how markets work. You need divergence for any sense of profit. So investing is a zero sum game or a negative sum after all the fees in the short term. Value comes from information arbitrage, insights, or emotional discipline, not just processing data. So market efficiencies only exist if someone is wrong. AI can't create inefficiencies if it's all the same. So liquidity crises and flash crashes may emerge from simultaneous trades that are triggered from AI if everyone is using the same data and the same algorithms. And so that's where it just won't really work out if we're all chasing the best AI based on all of the same data. Everybody has it, right? It's just going to be all automated and nobody's going to make any money off of that. And it's not sustainable for even our mental because we don't know what's going on. So that's why I've come to the conclusion that advisors won't be replaced by AI. Advisors solve behavioral problems, not just solving math, right? AI can optimize people. AI can optimize money and financials and math, but it can't optimize people. It's not asset allocation, but investor behavior that is often the biggest drag on returns. Let me repeat that again. It is not asset allocation, but investor behavior that is often the biggest drag on returns, says Dalbar Market Research in 2023, that showed that the average equity fund investor underperforms the market by around 4% annually due to emotional decision making. For example, panic selling, FOMO, market timing mistakes. Um, and this is also according to an advisor's alpha paper by Vanguard in 2020. Behavioral coaching is consistently ranked as the number one value driver by clients. So another thing to think about is trust, empathy, and life advice that can't be automated. Real financial planning isn't just the numbers, it's personal. So advisors help clients navigate events, death, divorce, retirement, illness, college planning. Clients want someone who listens, reassures, and helps align money with values. And AI lacks emotional intelligence because they can't just simply understand or read how somebody's feeling based on what they're doing or what they look like. That's a human trait. And this is a source, Cerulli Associates in 2020, 87% of high net worth investors say relationship and trust is why they keep their advisor. It's not because they have the best strategies, right? It's the trust that they have in somebody else. So let's go into a little bit more of regulatory and fiduciary oversight, though. Why it needs human judgment. Advisors don't just pick stocks. They navigate rules, taxes, estate laws, and compliance. Tax harvesting, inheritance rules. There's a lot of emotions around inheritance, right? Multi-jurisdiction planning. AI can support and make advisors more efficient by providing the rules, but the accountability still lies within somebody, within a human, right? So it's not that AI can't do it. It's not an ability problem. It's an accountability problem. So advisors who embrace AI will outperform those who don't. And the future isn't AI versus advisors, but AI augmented advisors versus the rest. So, for example, tools like Holistiplan, that's tax planning, or Right Capital, that's cash flow management, forecasting, can empower advisors to offer faster and deeper insights. Thus, advisors can spend less time on the spreadsheets and the number crunching and the strategies and more time on strategic thinking and relationship building. That's a source from McKinsey & Co. in 2022. So clients prefer humans still, regardless of all of this, right? High net worth and older clients especially want that human touch, but even younger investors, millennials, Gen Z, want these hybrid models because personal accountability can't be outsourced. And in conclusion, AI can tell you what to do, but only a human can tell you why it matters. That's why advisors won't be replaced, they'll be upgraded. Thank you for tuning into this one, and I hope you found this one valuable.